So, first of all, can I get your take on our inflation rate falling lower than what was expected by Bay Street? What does that tell you?
Yeah, so we're continuing to see inflation at the low threes, and this month it was the high twos. It's not terribly unexpected. It was a bit lower than folks had predicted, but this is roughly the range that the Bank of Canada predicted in its last full update for its projections last month. We're seeing this decline in the general rate. We're also seeing it in some of the core rates as well that the bank follows more closely in the core inflation rates that Statistics Canada publishes, but also the core rates that the Bank of Canada calculates. Now, key parts of this decline are actually due to what's called base effects. So particularly for gasoline, we're comparing the prices this January to last January when Winter Storm Elliott hit and drove prices up. And so we're seeing relatively lower prices as a result compared to this time last year. When it comes to food from grocery stores, we're seeing a similar effect where we saw big increases in prices in November and December, as well as January of last year. Now, those 3 months that saw big price increases have been kicked out of the series now. So they're out of the series. Not to say that prices went down, it's just to say that we are now comparing to this now much higher price level for grocery store food prices. What that means is that the value that's showing up in the headline figures of 3.4% this January versus last January is relatively lower. But that's not because prices have come down. It's rather because the big price increases that we saw around this time last year are now out of the series.
So, do today's numbers show us that we're getting closer, quicker to the Bank of Canada's goal of 2%, their target of 2% inflation?
Not necessarily. I mean, there is going to be some variance here. We're at the high end of the range that the bank wants to see at 2.9%. The bank wants to see a 1% to 3% inflation rate. We are within that. We might be a percentage or two above it next month. We were a percentage or two above it in the previous last couple months. But this is roughly what the bank is predicting going forward. I mean, I think it is worth pointing out that while food and gas have seen some declines, we're still seeing substantial pressure on shelter costs. Rent, for instance, is at the second highest year-over-year rate that we have seen over the last several years. The highest increase in rents was in October of last year. And so this is the second highest now at almost 8% year over year. Very big increases in rent. This is again being driven by high interest rates. High interest rates drive higher costs for landlords and they push those costs down to tenants. If we take a look at mortgage interest costs, these are continuing to go up as Canadians renew mortgages at these much higher rates. If they had a fixed year mortgage, say at 5 years, that is just coming up for renewal, they're paying, they have to renew and therefore they're paying higher mortgage interest costs. Those are up 55% since the rate hikes started. And by June, these are the January figures, by June, half of households who had mortgages will have renewed now at those higher interest rates. So we're not even at the halfway mark in terms of folks renewing at these much higher interest rates. So the higher interest rates continuing to have a big impact on shelter costs, even if we are seeing the price of, or the inflation rate rather, for food and gas come down in the January data.
Okay, so then before we wrap, I have to ask you about where interest rates are heading now. Does the report today put pressure on the Bank of Canada to lower rates maybe again sooner, March, June? What do you think?
Well, I hope that it does. I mean, shelter costs, which are being driven by interest rates, are an important part of why inflation is remaining high. And so decreasing the interest rate would decrease inflation in those particular areas, rent and mortgage interest costs, particularly for those with variable rate mortgages or those who have to renew. Certainly this figure at slightly below 3%. It's not a huge change from what the bank was predicting, although if we're reading the tea leaves, this is relatively positive news from the bank for the Bank of Canada, which may to some degree offset the news that the final quarter of growth in 2023 was likely positive and relatively strongly so. I mean, that's sort of positive news for the economy, but not necessarily for the Bank of Canada, which doesn't want to see strong economic growth. They want to see weak economic growth, weak wage gains, because those in the bank's mind would decrease inflation over the long term. So this may offset some of that good news from the end of last year. It's pretty clear that the next Bank of Canada decision in March, in about 2 weeks' time, likely isn't going to see a change. This isn't wildly out of line with what they were predicting in any event. And so we'll have to see. I mean, I think that the summer decision is likely one that we should watch more closely in terms of an actual change. I think it's pretty unlikely that we'll see a change in the March decision in about 2 weeks' time.